You did everything right. You cut expenses. You lived below your means. You built up savings. You sacrificed vacations. You skipped dinners out. You drove the same car for 10 years. You watched that savings account grow. And right now, in January 2026, you feel safe. Because you have money in the bank. And money in the bank means security, right? Wrong. And this is the most dangerous lie in personal finance today. Because while you were saving, something was silently destroying the value of every dollar you set aside. Inflation, interest rate manipulation, currency debasement, government deficit spending of $2.02 trillion in 2025 alone, all of it working together to erode the purchasing power of your savings faster than the interest rate is building it. Here is the brutal reality. If you have $50,000 in a savings account earning 4.5% and inflation is running at 3.7%, your real return is 0.8%. But when you account for taxes on that interest income, your real return drops below zero. You are actually losing money while watching your balance grow. And that is the best case scenario. Because the Federal Reserve's own projections show inflation staying elevated through 2026, whereas the national debt just crossed $38 trillion. Every dollar the government borrows and spends creates new money that chases existing goods. That is inflation, and inflation is a hidden tax on savings. It is a tax you never voted for. A tax nobody explicitly charges you, but a tax that takes a percentage of your savings every single year without asking. A family that saved $100,000 in 2019 and kept it in cash has seen that $100,000 lose 23% of its purchasing power by January 2026. In real terms, their $100,000 is now worth $77,000 they saved for years, sacrificed for years, and the system took $23,000 from them, silently, legally, without a word. Before we show you exactly how savings are being destroyed in 2026, who is most at risk, and what you can do to protect yourself before it is too late, hit that subscribe button and join the Wealth Forum. We expose the silent forces stealing your financial security so you can fight back. Turn on notifications, because what you are about to learn will completely change how you think about money, safety, and wealth. Now let's talk about how we got here and why this is different from anything your parents or grandparents experienced. Let's go back to 1970. Your grandparents could put money in a savings account and actually build wealth. In the 1970s and 1980s, savings account interest rates hit 10, 12, even 17%. Yes, 17%. In 1981, the average savings rate was 17.04%. If you had $50,000 in savings in 1981, you were earning $8,500 per year, just sitting there, doing nothing. And even after inflation, you were building real wealth. The system rewarded saving, it punished spending, and people who were disciplined and patient grew richer simply by keeping money in the bank. But that world is gone, and it is never coming back. Here is what happened. In the 1990s and 2000s, central banks around the world decided that low interest rates were the key to economic growth. Lower rates meant cheaper borrowing. Cheaper borrowing meant more spending. More spending meant more growth. So rates came down and stayed down. By 2020, the Federal Reserve cut rates to essentially zero. After the COVID pandemic, they kept them there for 2 years. And during those 2 years, inflation exploded to 9.1%, the highest since 1981, while savings accounts paid 0.06%, not 6%, 0.06%. You were earning 6 cents on every $100, while inflation ate 9% of your purchasing power per year. That is financial destruction, and millions of Americans sat through it without realizing what was happening to them. Now rates have risen. The Fed raised them to 5.3% in 2023 to our high-yield savings. Accounts are now paying 4.5 to 5%, and people feel safe again. People think saving is working again, but it is not, because inflation is not at 2%. Inflation is running at 3.7% as of December 2025. And the real cost of living, what economists call the experiential inflation rate, is even higher. Groceries are up 24% since 2020. Housing is up 38%. Auto insurance is up 52%. Childcare is up 34%. If you are a real person living a real life, inflation is not 3.7%. It is 15, 20, 25% depending on what you spend money on. And your savings account is not keeping up. Here is the analogy. Imagine you are running on a treadmill. The treadmill is inflation. It is always moving backward. You have to run just to stay in place. If you run at 45% and the treadmill moves at 3.7%, you are barely moving forward, a fraction of an inch per hour. But if taxes take 30% of your running speed, you are moving backward. The treadmill is beating you. And no matter how fast you run, you cannot win, because the treadmill speed is controlled by forces that have nothing to do with your effort or your discipline. The government controls it. The Fed controls it. And right now, they have no incentive to slow it down. Now let's talk about the mechanics. How exactly does the savings destruction system work? And why are traditional savings failing in 2026? Here is how your savings are being destroyed right now. 5 separate mechanisms working simultaneously, all legal, all invisible, all devastating. Mechanism 1 is currency debasement. Every time the Federal Reserve prints money or the government borrows more, it expands the money supply. More dollars chasing the same amount of goods means each dollar buys less. In 2020 alone, the Fed created $4.8 trillion in new money. That is more than all the money printed in the previous 100 years combined. Where did all that money go? It went into the economy, and it started competing with your existing dollars for the same goods and services. Your dollars suddenly had more competition and less purchasing power. The national debt is now $38 trillion. Every dollar of that debt represents money that was created from nothing and injected into the economy. And every dollar injected dilutes the value of every dollar you saved. Think of it like this. Imagine there are 100 pizzas in town and $100. Each pizza costs $1. Now imagine the government prints 100 more dollars. Now there are $200 and still 100 pizzas. Each pizza now costs $2. Your savings did not change. You still have $50, but now your $50 buys 25 pizzas. Instead of 50, you lost half your purchasing power, and nobody took a single dollar from your account. That is currency debasement. That is what governments do when they cannot control their spending. And the US government spent $6.75 trillion in fiscal year 2025 while collecting only $4.92 trillion in revenue. The difference, $1.83 trillion was created from nothing, and it is diluting your savings right now. Mechanism 2 is the inflation tax. Inflation is not just rising prices. It is a transfer of wealth from savers to debtors. If you have $100,000, in savings and inflation runs at 5%, you lose $5,000 in real purchasing power. But if you have $100,000, in debt and inflation runs at 5%, your real debt burden falls by $5,000. The government has $38 trillion in debt. If inflation runs at 5%, that debt burden falls by $1.9 trillion in real terms. The government is the world's biggest debtor. They benefit enormously from inflation, which is why they have no real incentive to eliminate it. They say they want 2% inflation, but 2% inflation is still destroying your savings, just slowly. Mechanism 3 is financial repression. This is the deliberate policy of keeping interest rates below the rate of inflation. When savings account rates are lower than inflation, savers are quietly penalized. Their real returns are negative. The government and central banks do this intentionally. By keeping rates low, they make borrowing cheap. They reduce their own interest payments on the national debt, and they force savers into riskier assets like stocks and real estate, inflating asset prices. This is called financial repression, and it was used extensively after World War II to inflate away the massive war debt. The government is doing it again, using the same playbook, and your savings account is paying the price. Mechanism 4 is tax erosion. You earn interest on your savings, and that interest is taxed as ordinary income. If you are in the 22% tax bracket and you earn 4.5% on your savings, your after-tax return is 3.51%. If inflation is 3.7%, your real after-tax return is negative 0.19%. You are losing money. And because inflation pushes incomes into higher tax brackets through bracket creep, your effective tax rate on savings income increases every year without any change in the tax code. The system is designed to extract maximum value from savers while making the extraction invisible. Mechanism 5 is the opportunity cost trap. Here is the most insidious mechanism of all. While your savings sit in a bank earning 4.5%, real assets are appreciating faster. Gold is up 28% since January 2024. Real estate and major markets is up 12% year over year. The S&P 500 is near all-time highs, and Bitcoin has surged. Your savings account protects the number, but the number is becoming less valuable every day relative to real assets. Keeping money in savings is not just earning a low return, It is missing the gains that inflation-resistant assets are generating. It is a guaranteed path to relative poverty, even if your balance never goes down. These 5 mechanisms work together. Debasement erodes purchasing power. The inflation tax transfers wealth from savers to debtors. Financial repression keeps returns below inflation. Tax erosion eliminates what little positive return you have. And the opportunity cost trap means you miss the inflation hedge that real assets provide. All 5 are working against you right now, simultaneously, and most people have no idea. Now let me show you who is getting destroyed most, and how close we are to the breaking point. Here is the crisis, and here is who it is hitting hardest. 3 groups of people are being systematically destroyed by the savings crisis of 2026. Group 1 is retirees and near retirees, people who were told their entire lives to save money, to build a nest egg, to keep money safe in conservative accounts. These are the most disciplined savers in America, and they are being punished for their discipline. A 68-year-old retiree with $500,000 in savings accounts, earning 4.5%, is earning $22,500 per year. But their actual cost of living is rising 7 to 8% per year. When you include healthcare inflation of 9.4% as of 2025, they are losing ground every year. They are spending down principal to meet rising expenses. And the faster their expenses rise, the faster the principal depletes. Many retirees who thought they had enough in 2020 are discovering in 2026 that they do not. Because $500,000 in 2020 had the purchasing power of $388,000 in January 2026. After cumulative inflation, they did not spend it. Inflation spent it for them. Group 2 is middle-class savers, people earning $60,000 to $150,000 per year who are doing everything right, working hard, spending less than they earn, building emergency funds, saving for retirement. These people are the backbone of the American economy, and they are being squeezed from both sides. Their savings are losing real value due to inflation, and their ability to save is shrinking because the cost of everything essential has exploded. Housing costs for median income. Families consume 43% of take-home pay in 2025, up from 28% in 2015. Healthcare costs have doubled since 2010. Food costs are up 24% since 2020. The middle class is spending more on necessities and saving less, and what little they do save is being eroded by the inflation system. They are running faster on the treadmill every year, and the treadmill keeps speeding up. Group 3 is young workers under 40, people who are just starting to build wealth, people who are told to save, to invest, to build a future. But in January 2026, 64% of Americans under 40 live paycheck to paycheck, not because they are irresponsible, but because the cost of entry into a middle-class life has become prohibitive. The median home price in America is $428,000 as of December 2025, a 20% down. Payment is $85,600 on a median household income of $78,000 per year. Saving that down payment at any reasonable savings rate takes over 15 years. And by the time they save it, home prices will have risen another 30%. The goalposts are moving faster than they can run, and their savings, even when they exist, cannot keep pace with the asset inflation that is pricing them out of wealth-building opportunities. Here is the turning point, the convergence that makes 2026 different from any year before. Inflation is staying elevated at 3.7% despite the Fed's best efforts. The government cannot stop spending because entitlements are growing faster than revenue. The national debt is growing at $7 billion per day. $7 billion per day, every single day. That is adding to the money supply, adding to inflation pressure, and making the savings destruction worse with every passing hour. The Fed is caught in a trap. If they raise rates more to fight inflation, they increase the cost of servicing $38 trillion in debt. Every 1% increase in rates costs the government $380 billion in additional interest annually. They cannot afford that, so they keep rates just high enough to look like they are fighting inflation, but not high enough to actually stop it. And here is what most people do not understand. The real inflation target is not 2%. It is whatever it needs to be to inflate away the debt, without causing an open political revolt. Right now, with $38 trillion in debt, even 3% inflation for 10 years reduces the real debt burden by nearly a quarter. And 5% inflation for 10 years cuts the real debt burden in half. The government benefits, debtors benefit, and savers are destroyed. This is not a glitch in the system. It is a feature. The system is working exactly as designed. The design just does not include you. The moment of revelation is this. If you are keeping more than 3 to 6 months of expenses in traditional savings in 2026, you are not playing it safe. You are volunteering to have your wealth slowly confiscated. Every dollar above your emergency fund that sits in a savings account is a dollar losing real value. Every month you wait is a month the system takes from you. And the longer you wait, the harder it becomes to recover the ground you have lost. Here is what happens if you do nothing, and here is what to do instead. Consequence 1 is gradual impoverishment. It does not happen overnight. That is what makes it so dangerous. Your balance grows, but your purchasing power shrinks, year after year. And by the time you realize what happened, decades have passed. A person who kept $200,000 in cash savings from 2020 to 2030 will have $200,000 in their account. But the real value of that, $200,000 will be approximately $140,000 in 2020. Purchasing power, 30% of their wealth, destroyed silently without a single dollar being taken. Consequence 2 is retirement shortfall. If you are planning to retire on savings, and your savings are losing real value, you need more savings than you think. The old rule was 25 times your annual expenses. If you spend $50,000 per year, you need $1.25 million. But if inflation averages 4% over your retirement, instead of 2%, you need 36 times your annual expenses. That is $1.8 million. The shortfall is $550,000, and most people are not even saving at the old rate. They are falling further behind every year. Not because they are not trying, because the system is designed to keep them behind. Consequence 3 is the forced risk-taking trap. When savings returns cannot keep up with inflation, people are forced into riskier assets to preserve purchasing power. Stocks, real estate, crypto, assets that can protect against inflation but also expose you to crash risk. This is exactly what the government and Fed want. They want you in risk assets. They want asset prices high, because rising asset prices make people feel wealthy, and feeling wealthy means less political pressure on the government to fix the debt problem. So they push you out of savings and into risk. And when the market crashes, ordinary people lose twice. They already lost to inflation, and then they lose to the crash. This is the trap. And most people walk right into it. So what do you do right now in January 2026? 5 specific actions that can protect your savings from the mechanisms destroying them. Action 1 is keep only 3 to 6 months of expenses in traditional savings. Your emergency fund should be in a high-yield savings account, earning the best rate you can find. Currently, that is around 4.9% at the leading online banks. But do not put more than your emergency fund here, because every dollar above your emergency fund is volunteering for slow confiscation. Action 2 is buy inflation-protected assets. Treasury inflation-protected securities, known as TIPS, automatically adjust for inflation. I-bonds, Series I savings bonds, are designed specifically to protect against inflation. They currently yield around 3.11% above inflation. If inflation is 3.7%, you earn 6.81%. That is a real return. That is actually building wealth. Action 3 is hold physical gold and silver. Gold is up 28% since January 2024 and is now trading near $5,000 per ounce. Gold does not pay interest, but gold maintains purchasing power over time. An ounce of gold in 1971 bought a good men's suit. An ounce of gold in 2026 buys a good men's suit. The gold did not go up. The dollar went down. Physical gold stored outside. The banking system is immune to currency, debasement, and financial repression. Action 4 is invest in real assets that generate cash flow. Rental real estate produces income and appreciates with inflation. Dividend-paying stocks in essential industries produce income and hedge against inflation. Farmland, timberland, infrastructure. These are assets that inflation cannot destroy because they produce real goods and services. When prices rise, the income from these assets rises with them, and your savings do not. Action 5 is reduce debt with variable rates. This is counterintuitive but critical. If inflation is going to continue destroying purchasing power, your debts are also being inflated away. A mortgage at 3% fixed is an asset in an inflation environment. A credit card at 24%. Variable is a wealth destroyer in any environment. Eliminate high-interest variable rate debt immediately. Keep fixed-rate debt. And understand that in an inflationary world, being a prudent debtor is often better than being a disciplined saver. So here is the lesson. Saving money is not enough anymore. It was enough for your grandparents. It was enough for the first half of your parents' lives. But the rules have changed. The game has changed. And if you are still playing by the old rules, you are losing, slowly, silently, but you are losing. The system has been redesigned to extract wealth from savers and transfer it to debtors, asset holders, and governments. Currency debasement, inflation taxation, financial repression, tax erosion, opportunity cost. All 5 mechanisms are working against your savings right now. In January 2026, as you read your bank statement and feel safe because the number has not gone down, the unsettling truth is this. In the modern financial system, the safe choice is no longer safe. Keeping money in cash is a guaranteed slow loss, and the only way to protect yourself is to stop thinking like a saver and start thinking like an investor. Not because investing is glamorous, not because it is easy, but because the system has made saving insufficient for wealth preservation. The rules changed, and most people do not know it yet. Subscribe now to the Wealth Forum for continued coverage on how to protect your wealth in this new financial environment. Turn on notifications. Share this with anyone who thinks their savings account is keeping them safe. Because the next video breaks down exactly where to put your money in 2026 to stay ahead of inflation. But before you go, leave a comment. Tell me this. After watching this video, do you think your savings are actually protecting you? Or have you realized that keeping cash in the bank is slowly making you poorer? Because I want to know how many people are finally waking up to what the system is doing to their money. Your savings are not as safe as you think. The system is not on your side. And the longer you wait to act, the more the system takes from you. The only question is whether you wake up in time to do something about it.